Insurances play an essential role in our lives. They make sure that the risks of daily life, for example, accidents, fires, or diseases, are not turning into an existential threat to individuals, households, or businesses. Some of these insurances are contracted at a voluntary base. These include household insurance, insurance for theft, and travel insurance. Other insurances are required by law. For example, third-party liability insurance must be taken out when somebody purchases a motor vehicle or operates a cable car. Thanks to these insurances, the victims of any accident can be sure to receive compensation regardless of whether or not the party responsible for the accident is able or willing to pay for the damage done. Insurance is based on the principle of transferring risk to the community of insured parties. Insurance companies manage this risk transfer. In addition, they assess individual risks. When evaluating the risk for property insurance, the following elements are taken into account. First, the value of the insured item. Secondly, the insurable risks that this item could be exposed to or which it can cause. And third, the damage that these risks could cause to or by the insured item. The insurance premiums are then determined based on the likelihood of risk and the expected amount of damage. In the case of personal insurance, especially capital-forming life insurance, life expectancy is the key element. The insurance premium and the expected interest rate earned on the capital market determine the amount of capital that can be saved until the day of retirement. The monthly annuity is then calculated on the basis of statistically remaining life expectancy. The main business of insurance companies is risk management. In this context, the so-called law of large numbers takes center stage. The bigger the community of insured parties and the more information about the structure of risks is available, the more accurately the amount of expected insurance claims for property insurance can be predicted. The same is true for age distribution of expected deaths. Random fluctuations decrease with the amount of insured parties. However, the law of large numbers does not provide any information on which specific person or company will be affected by a certain loss. In 2012, insurance companies active on the Austrian market received insurance premiums in the total amount of 16 billion euros. This translates into a statistical insurance premium average of 1,921 euros per capita. Life insurance accounts for approximately 40% of Austrian insurance premiums and all other insurances for the remaining 60%. Overall, these premiums account for 5.3% of Austrian GDP. On the other hand, in 2012, insurance companies active on the Austrian market paid out a total of 12.8 billion euros to insured individuals and companies. The difference between premium, income, and payments to insured persons and companies is used by insurance companies to cover their current expenses, such as salaries to about 60,000 employees and expenses for innovation. In addition, this difference is also used to create reserves. At year-end 2012, the assets held by all Austrian insurance companies amounted to 130 billion euros.